All right, let's get right into it. Today, we're going to break down a really fascinating, and I have to say, theoretical investment strategy for precious metals. It's basically a playbook that uses a very specific and very wild moment in market history as its guide, the year 1975. And this one quote right from the source material, it just says it all, doesn't it? It's about completely flipping the script. It's about seeing a massive opportunity when everyone else is panicking. This isn't about reacting. It's about having a cold, calculated plan.
So here's how we're going to unpack this playbook. First, we'll look at the 1975 market echo, why that year is so important. Then we'll dig into the core philosophy, this idea of building a floor. After that, it's all tactics, the plan for gold, and then the plan for its more explosive cousin, silver. And finally, we'll wrap up with the key signals to watch for that might tell you the next big move is on its way.
Okay, so let's set the stage. The whole idea here is that the market is in what the source calls a shakeout phase. And this phase feels, well, an awful lot like what investors went through way back in February of 1975.
Now, here's the key takeaway from that. According to this theory, you're not looking for a sudden dramatic crash. No. Instead, you should expect a long, drawn-out, and honestly super frustrating period where prices just chop around or slowly grind down. The whole point of a phase like this is to just wear people out, to make them give up and sell right before the real fun begins. So if the market's goal is to frustrate you into selling, how do you possibly counter that? Well, that brings us to what is, without a doubt, the single most important rule of this entire playbook. It's a total shift in how you think about buying. And this slide just lays it out perfectly. The classic mistake, right? You see a price drop, you think, wow, that's cheap, and you throw all your money in at once, trying to be a hero and catch the exact bottom. But the winning strategy, according to this analysis, is to methodically, patiently build your position over time. See, the goal isn't to get the lowest price. The goal is to get a great average price. And there's a name for this. It's called tranche buying. It's simple, really. You just decide how much you want to invest in total, and then you deploy that capital in smaller pieces, in tranches, as the price hits specific levels you've already decided on. It's a way to take the emotion completely out of the game and just stick to the plan. All right, so theory is great, but how does this work in practice? Let's apply this philosophy to the first asset in our playbook, gold. You can think of this as the foundation of the whole strategy. Now, for this whole scenario to work, we need a starting point. The source analysis uses a hypothetical peak in gold at around $5,600. It's important to remember that all the price targets we're about to talk about are based on that specific peak. So, if history from 1975 is our guide, the playbook is expecting a pretty hefty correction. We're talking a 30 to 40% drop from that peak. I know, that sounds deep, but that pullback is precisely where the opportunity is. Okay, this slide. This is the heart of the gold strategy, so let's break it down. It's all about zones. Zone 1 is called the trap for a reason. It's where people jump back in too early. So you just wait and watch. The real action starts in Zone 2, your value zone. That's where you deploy your first tranche. But look at Zone 3, the gift. This is a full 50% drop from the top. The news will be terrible, everyone will be negative, and that's your signal to buy with your second, bigger tranche. And then, maybe you get Zone 4, a potential generational low where you go all in. So, how can you tell if a bottom is getting close? The playbook points to a classic technical signal, volume divergence. It sounds complicated, but it's not. All it means is that the price is still trickling down, making new lows, but the energy behind the selling is fading. The volume gets smaller and smaller. It's like the sellers are just getting exhausted. All right, so we've got our steady foundation with gold. Now let's talk about its wild, unpredictable, high beta cousin, silver. When you hear high beta, just think high octane. It means silver is expected to move way more dramatically than gold in both directions. It's a higher risk, higher reward kind of play. And just like we did with gold, we need a starting point for the silver strategy. In this case, the analysis uses a hypothetical peak price of around $122. This quote is, well, it's everything. It perfectly captures the mindset you need for silver. The historical parallel isn't just a correction, it's a complete wipeout, an obliteration. But that's exactly what set the stage for an absolutely legendary 30x bull run. It's the definition of extreme risk and extreme reward. Now, the silver strategy is even more aggressive. You see, Zone 1, again, is a place to avoid, where people get chopped to pieces by the volatility. But check out Zone 3, the crash bid.
That's fascinating. The playbook suggests the price could fall so hard, so fast, that you'd need to have your buy orders, your limit orders, already set and waiting just to catch it. And then in zone 4, despair, the tactic changes completely. It assumes premiums on physical coins will go through the roof, so the strategy shifts to using a trust like PSLV to get exposure. And that brings us to this really cool pro tip from the source. It's called the Sprott arbitrage. Here's the deal. In a true panic, the price of the PSLV fund can actually fall even faster than the price of silver itself. And if that discount gets big enough, say 5% or more, you can buy shares of the trust and basically get ownership of physical silver for way, way less than the already crashed market price.
Okay, you've been patient, you've followed the plan, you've been the vulture. So now, the million-dollar question. How do you know when the shakeout is finally over and the next big wave, what the source calls the mania phase, is about to kick off? Well, the source gives us 3 key signals to watch for. Number 1, a whisper from the Fed, any hint that they have to step in and stop bond yields from rising. Number 2, the gold-oil pivot. That's when oil is crashing because the economy's in trouble, but gold stops going down with it. It starts acting like money again. And number 3, the social signal, retail capitulation. When you see headlines calling gold a trap and all your friends have lost interest, that's usually the point of maximum pessimism, and often right before the turn. So let's just boil this whole thing down. The plan in a nutshell is, first, understand you're in a shakeout phase. Second, do not chase these little rallies. They're probably traps. Instead, you set what are called stink bids, limit orders sitting way down at your target zones, waiting. And finally, you consider using financial trusts to get your exposure without having to pay those insane premiums on physical metal when things get crazy. Look, at the end of the day, what we've walked through is a detailed, theoretical strategy, and it's all built on a really compelling parallel to history. It gives you a clear, disciplined plan for a potential downturn. But the one question nobody can answer is the one on the screen. Is the past really prologue, or is this time going to be different?